Hello everyone, my name is Anjani Kumar Khetan and I am based out of Bangalore. In this particular video, we will look at another interesting topic which deals with how an entity needs to account for employee loans which are given at off-market rate of interest. So for example, if the market rate of interest is say 10%, and the employee loan, say as part of the employee welfare scheme, is given at a discounted rate of just 5%, how the accounting for these loans are to be dealt with under both IFRS and Ind AS. Now, you might be familiar about this particular topic, but let me tell you, I believe firmly that by the time you will come to an end of this particular video, you will learn something new even if you know about this topic. Why? Because at the end, I will also explain to you, once we have seen the case study, I'll explain to you the logic why accounting like this has been prescribed under IFRS and Ind AS world. So with that background, let us see a case study. Okay. So let's first understand the scenario with the help of a case study, and then we will see the accounting, how it is being dealt with. So let us take a scenario wherein Citicorp as an entity, this Citicorp has provided, let us say, loan of 16 lakhs to one of its employees. This is the amount which have been of loan which have been provided. Now, the interest rate contractually payable on the loan is 5% per annum, whereas the market rate of interest is 10%. Thereby, meaning that this particular loan is at a concessional rate of interest. Now, assume further that contractually this loan of 16 lakhs is repayable in 5 equal annual installments at the end of the year. That means 1/5 of this amount will be paid at the end of year number 1, and the same 1/5 will keep getting repaid at the end of year number 2, 3, 4, and 5. Now, apart from that, for each year, not only you will pay the principal, the repayment of principal representing 1/5, plus interest for that year also need to be paid. This is the contractual terms where, of the loan with the employee. So this is the associated cash flows which stream which is there in the employee loan. Now, given this, the question is, these are the 4 questions which we will try to address, that given the above information, we need to calculate the cash flows associated with the loan as the employee starts repaying the loan, right? Then, what is the amount at which the loan, which is of the value of 16 lakh rupees, at what amount gets recorded in the books of Citicorp? We will see that the recording of the loan will not be at 16 lakhs, okay, but for a different amount. How that amount is calculated, what is the logic, and how do we go about it is something which we will also look at. And the third and the fourth question is that having computed this, having determined what is the loan at which the recording has to be done at initial recognition, what would be the amortization table, and what journal entries need to be recorded by Citicorp. All of these questions we will handle by one. But before we get into that answer per se of this particular case study, it is not out of place to recall what is the requirement under the financial instruments standard, whether we call it IFRS 9 or Ind AS 109. What are the requirements? The requirements of the standard is given in paragraph 5.1.1. Now, this paragraph 5.1.1, both under Ind AS 109 and IFRS 9, both, they're the common paragraph. This paragraph number says that depending upon what is the type of your financial assets, you might already be aware that these are the 4 types of financial assets which are possibly, could be there. Now, what the standard tells you that irrespective of the type of the financial asset which you are dealing with, Like in our case, because of the employee loan will fall into amortized cost category. Now, the paragraph 5.1.1 says, irrespective of that, initial measurement of all financial assets will be at fair value. So initial measurement is always at fair value, and that fair value is determined under Ind AS 113, fair value measurement standard. Now, that means the initial measurement is agnostic of the type of the financial asset being involved. But there is a slight difference in terms of the treatment of the transaction cost. So for example, if you have this particular category of financial asset wherein financial asset is measured at fair value through profit and loss account, here any transaction cost associated with such financial asset is also charged to P&L. It gets debited to P&L 100% at the time of issuance. But the other three categories of the financial asset, if you incur transaction cost associated with them, those transaction costs gets adjusted in the carrying amount of the asset. That's the way the requirement of paragraph 5.1.1 is there for the recording and initial measurement of your financial assets. Now, with this background, our focus basically would be on this category, that's where the employee loan falls into. So with this background, let us see how do we solve this particular case study, each of these questions one by one. And at the end, I will give you the significance of the accounting, the way it is contemplated under IFRS 9 or Ind AS 109. So given the information on the last slide, how the cash flows are there associated with this particular employee loan, contractually, if you look at, as per the contract, contractually, you have a 5-year loan. The loan is given for 16 lakh rupees. And we have seen in the prior slide where we said that 1/5 of the principal is being paid at the end of each year. So 1/5 of 16 lakh will be 3,20,000. So for each of the year, 3,20,000 each year would be your principal repayment as per the contractual terms. And because you are making the first repayment at the end of year number 1, that's how the case study gives you the information. Therefore, the entire loan of this 16 lakhs remained outstanding for the full year. And therefore, you will calculate the interest on this particular loan contractually at the contracted rate of 5%. That's what the employee has committed to pay to the company. So therefore, 5% of the outstanding balance of 16 lakh would be 80,000. So for year number 1, what would be the total cash outflow from an employee's perspective? So employee will pay a repayment of 3,20,000 being 1/5 of the loan plus 80,000 being the interest at the rate of contracted rate of 5% on 16 lakhs. Therefore, in total, the total cash outflow for the year is 4 lakh rupees. The sum total of 320 and 80 is captured in this particular column number 5, which is 4 lakh is your total cash outflow. Now, out of this 4 lakh, though the total cash payout is this, the principal repayment is only 320. And therefore, what would be your closing principal? 16 lakh minus 320. That means 12,80,000 would be your closing loan liability. And that 12,80,000 becomes your opening for second year. Again, out of this 320 being 1/5 of 16 lakh would be your principal repayment. And then 5% of this amount of 12,80,000 will be 64,000. That's your interest obligation contractually, as per the contractual terms, is your interest obligation. Same way, you compute the entire table and you will see, if you look at each of the year, you will calculate interest at the rate of 5% on the opening balance for the respective years. This would be your interest component, which you need to repay as an employee. And this is your principal repayment for each of the year. The sum total of these two represent the total cash outflow. This plus this, each of these line items will represent your total cash outflow in the 5-year tenure of the loan. And this becomes the closing liability. Of course, at the end of the 5th year, the liability becomes zero based on this table. Now, if you see this table carefully, what is happening? We have already seen 320 is your 5 annual equal installment of the principal, and this interest is 5% of the opening balance. Your basically your interest obligation for each of the year. Now, this total cash outflow of 18,40,000. What is 18,40,000? Sum total of all of these numbers, which is what we computed here in column number 5. Now, this 18,40,000 is your total cash outflow associated with this particular employee loan, and this cash flow stream, what you have, this cash flow stream, this now needs to be discounted at the market interest rate. We've been given the loan at 5%, but market interest rate is 10%, and therefore this stream of cash flow needs to be discounted at the market interest rate of 10% to arrive at the fair value of the loan. How do we do that? Let us see in the next slide how the computation of the fair value of the loan is being done. So continuing from what we have discussed in the previous slide, now we compute the fair value of the loan. Fair value of the loan is, as I said, total cash outflow of 18,40,000, which we've computed on the last slide. So for each year, you have an outflow of 4,384, 368 like this. And in each of these installment, the principal of 3,20,000 in each year is included, right? So with this cash flow stream, and if the discounting rate is 10%, which in this case is the market interest rate, then present value factor at 10% would be these numbers. In many of my earlier videos, I have explained to you how to compute. These can directly be obtained from the present value interest factor tables also, which is available in any of the standard financial management books. But if you simply look at how this 0.909 has been calculated, it is nothing but 1 divided by 1.10. 10% is the discount rate to the power of the year number 1. So second one, 0.826 will be 1 divided by 1.10 to the power 2. If you solve this, you get these PV factors. But as I mentioned, these PV factors can readily be obtained from the PV factor tables. In any standard textbook, you will see in the appendix, these tables are given. So, total cash outflow into the present value factor. If you multiply each of these line items with the present value factor, it will give you your present value. So the present value of this stream of cash flow at 10% discount rate is only 14,06,224. Now this computed number of 14,06,224 will be reckoned as the fair value of the loan. And now you will use this number of 14,06,224 and then you will develop the loan amortization schedule. How we will do that? We will see in the next slide. But let us see here one important point. The cash which the company has given to the employee is 16 lakhs. The fair value of the loan is only 14,06,224. So the loan amount is 16 lakhs. Fair value of the loan, as we have computed, is only 14,06,224, which means there is a difference. The difference of 193,776, the difference between these two numbers. This, if you look at paragraph B5.1.2a of both IFRS 9 or Ind AS 109, this requires us to record it, this excess to be recorded on the basis of the relationship between the two parties involved. Now in this case, because the parties involved are employer and employee, this excess can be recorded as a prepaid employee benefit expense, and this prepaid employee benefit expense need to be amortized over the tenure of the loan. That means the amount of this 193,776 will be amortized, say in this case on a straight line basis for each of the year during which the loan subsists. So in this case, 193,776 divided by 5 will be the annual amortization of this prepaid amount, so that by the end of the fifth year, the entire prepaid gets nullified to 0. Now, we have seen, or we just now explained, that you will amortize it, but so credit will go to prepaid. What about debit? That is something which we will look at when we go and look at the last slide on the journal entries. That time I'll explain to you where the debit will go. So, two things which we have seen. In the previous slide, we have seen the cash flows associated with the contractually what the employee is supposed to pay. Then we have computed the fair value. Fair value of 1406,224. Now using this 1406,224, now we will develop loan amortization schedule. This is something which we will see in the next slide. Let us see how the loan amortization schedule is to be developed. It's a simple thing. We would have seen this in many other the examples as well. So in this particular case, the fair value of the loan is 1406,224. When you are developing the loan amortization schedule, this fair value of the loan becomes your opening loan liability. Now, you have to accrete interest on this principal because the entity has given loan to the employee. Therefore, the entity is entitled to interest income. Now, the interest income is not, for the purpose of accounting, it is not on the basis of the 5% contractual rate. Rather, it will be on the basis of the market interest rate of 10%. And therefore, the rate which you use to discount the cash flows using the same rate of 10%, you will now do interest income accrual you will do for the entity. So how the schedule will look like? 10% of this number, which I have given the formula here, 10% of 1406,224 will be 140,662. This would be the interest accrual for this particular loan amount. And the outflow will be contractual. If you remember in the last slides, we have computed for this first year, 4 lakh is nothing but 3,20,000 of your principal repayment, 1/5, plus 80,000 of your first year interest. What is 80,000? 5% of 16 lakhs. So this table or this column of the table I have brought forward as we have computed in the earlier slide. So with that said, how your loan amortization schedule will work? This is your opening. Then this is the interest income which you accrue. This is the amount which you will receive from the employee for that year number 1. And that will give you the closing liability for this loan amortization schedule. So opening plus interest accrual minus what you have received the cash will give you the closing loan liability for this loan amortization schedule. This becomes opening for year number 2. Same process you repeat. Now 10% of this will be your second year's interest income accrual. You will get contractually 384 of cash, which includes 3,20,000 of principal repayment, also representing 1/5 for year number 2, and that will give you closing liability of 877,531, which is opening amount plus interest income accrual minus 384 cash paid. This is your closing, and you will repeat this process till the end of 5th year, and therefore by the end of the 5th year, this loan will be squared off to 0. Right? That's how the loan amortization schedule will work. So therefore, interestingly, as I told you, you will note 1406 is the opening principal representing fair value of the loan, which we computed on the earlier slides. And these two numbers, interest accrual and cash outflow, this cash outflow is straight coming from what we have computed in the previous slide, representing 1/5 of the principal plus interest for each of the year. Now this is interesting. What is 433,776? as I told you, this represents the interest income. This entire stream represents the interest income to be recorded by the entity CT Corp for the employee loan that has been given. Now remember, the loan contractually the employee will pay only 2,40,000 as per the contract, because the rate of interest is only 5%. But from the Ind AS 109 or IFRS 9 perspective, the income which the CT Corp will record in respect of the interest will be 4,33,776. Let us see how the journal entries in this case will get recorded, and then I will explain to you how and why this particular accounting have been suggested, impact of this particular accounting. So, on initial recognition, when the loan has been given, we know, okay, the company has paid 16 lakh of cash in bank. Debit to the employee loan will be at the fair value of the loan which we computed earlier, 1406,226. And I explained to you the difference between these two numbers, 16 lakhs and 1406, because the relationship between the employer and employee is there in this particular case study. The delta, the differential debit will be recorded and parked in prepaid employee expenses in the balance sheet. The difference of these two represent 193,774. Now, as I mentioned, this prepaid need to be amortized over the tenure of the loan, which happens to be 5 years in this case. So we will see subsequent journal entries, how it gets recorded. So this is the journal entry on initial recognition. What happens subsequently? So at the end of each year, I have simplistically put all the entries together. At the end of each year, end of year number 1, 2, 3, 4, 5, and total also I have given. Now, based on the table which we created earlier, interest income need to be accrued. So in the previous table we have seen, table C on the last slide, we have seen the interest for each of the year is computed in that table. So if you bring the number from that table, the journal entry which you will record is, you will credit interest income in P&L and you will increase the value of your loan to the extent of the same amount. So for first year, you will record an entry of interest income credit in P&L 146,222 and increase your loan outstanding. Same way, year number 2, 3, 4, and 5. As I told you, the total income, interest income over the 5-year period will be 433,776. So by recording these 5 journal entries for in each of the year, you have recorded the total interest income of 433,776. And to the same extent, you have now increased the loan liability. So what was your loan liability? Initially was 1406,226. And by recording these 5 entries, you have increased the loan liability by 433,776. And that's exactly what I'm mentioning here. So if you add these two numbers, you're at the end of year number 5, by recording these entries, your total loan balance will be 18.4 lakhs. Sum total of this plus this. Right? There's 2 rupee of rounding of difference because of the decimal. Ignore that. Okay, so this makes up the loan balance of 18.4 because in each of the year you are increasing the loan amount by the interest accrual. Now, each year you will also receive cash. So, second entry each year you will record is the cash which you will receive. Now, this cash, this entries, the numbers of the entry also is being brought forward from table number C, which we computed on the last slide. It is nothing but what is the total amount, total cash outflow, which we computed for each of the year. So total 18,40,000 is the total. What is 1840? 1840 is nothing but 16 lakh of principal and 2.4 lakhs of your contractually the interest you are supposed to pay at 5%. Right? So the 18.4 lakh is the total cash outflow which will happen in this case. So you will record the entry for each of the year cash being received. Now we should not forget about amortization of this 193,774. So the third entry which you will record in each of the year is amortization of this prepaid expense. So because it's a debit, you will credit prepaid expense in each year, as I told you, equal amount, 1/5, because the tenure of the loan is 5 years. So 193,774, each year you will credit the prepaid, and therefore at the end of the 5th year, prepaid will become 0. The debit depends upon, again, the relationship between the two parties involved. Now, because in this case, the relationship between the two parties, the employer and employee, the debit should go to employee benefit expense. Why? Because what is the driver? Why the concessional rate loan has been given? Because it is like an employee benefit which has been given to the employees of the entity. And therefore, the debit in the P&L will go to this employee benefit expense. So, to the extent of 1,93,774, you will debit P&L. In each of the year, you will record these amounts. Now, so if you look at this 433, which is your interest income, and this 193, so what is happening? In P&L, you have given a credit in the interest income. If you look at the P&L, if you look at 5-year collectively, in the credit side of the P&L, 433,766, you have given a credit for the interest income based on market rate. But you have also debited to the P&L an amount equal to 193,774. So what does it mean? If you look at on a net P&L basis, you have charged in the P&L a net amount of 240,000. The difference of these two, the net credit to the P&L, net credit to the P&L, this is the credit of this much of income, this is the debit of your employee benefit expense. So the net of these, the credit amount of 240K is what you have credited to P&L. And this is the significance of this particular accounting. Why? That's what I told at the beginning. I'll explain it to you. Now, the accounting of this type actually reflects the substance of the arrangement. Now, in this case, the interest rate was 5% and the market rate was 10%. Now, let us assume if the market rate is not 10% but more, let us say 12%. Now, what will happen? When you are computing the fair value of the loan, you will do the discounting at 12%. That means the present value of the loan, because it's a higher rate, will be a lower number. And therefore, if you look at simplistically, in our case study, what is the delta or the benefit which the employee has? Benefit of 5% of the interest rate. But if the market rate is 12%, then the delta of 7% is there, that the employee is getting benefited by 7% lower interest rate. So in the second scenario, which we have not covered specifically in the case study, there is a larger benefit. And therefore, the fair value of the loan will be, because the interest rate is higher, will be lower. And therefore, the delta between 16 lakhs and the fair value of the loan at 12% will be far greater than 193,774. So why this accounting has been given? Just to ensure, irrespective of the fact, if the market, let's say one entity with 10% market rate gives the loan at 5%. Another entity with 10% market rate gives the loan at 3%. Now, the net effect for these two entities will be exactly the same, because for 5%, this is what the effect would be. But if an entity which has given the loan, when the market rate of interest is 10%, at 3%, therefore, if it is at 3%, if your discount rate is lower, the discounted value will be higher. If the discounted value will be higher than 16, and the benefit, the delta, will also get accordingly changed. So therefore, the net effect of this accounting is this, that in the P&L, you will have interest income and you will have charge in terms of employee benefit. The net effect in either of the two cases which I mentioned will be the same. So that is the substance of this particular accounting and how the journal entries are to be recorded. I hope this video was something which is useful to all of you. And even if you knew some of these concepts, at least this video would have added some new concepts or the new insights to what you know of. So this is exactly what I wanted to cover for this particular video. This is my contact details. This is the link to my YouTube channel, and this one is for my LinkedIn. Please do subscribe to the channel, provide comments. If you can give some inputs in terms of whether what is your take in terms of the quality of the video, is it something which is useful to all of you? This will help me in understanding whether the endeavor which I have started, it is something which is paying off for you as a professional. Or if you want any tweaks, please put those comments and I will try to incorporate all of those tweaks in future videos. Thank you for now and have a great, wonderful rest of the day. Thank you. Bye, and I will see you in the next video.